Gold miners continue to struggle as the GDX trades below its 50-day moving average. So is it a buy? According to our next guest, maybe not. Joining us today is Chad Morganlander, portfolio manager for Stifel. Thanks for being with us on the show.
Thank you for having me.
So we've got technical analysts saying that a dip below the 50-day moving average on the miners index would be a buy signal, but you seem to prefer the underlying metal. Is that correct?
Yeah, so the general thematic for this discussion should be that you can get the trade right from a thematic perspective, but actually buy individual equities and get it wrong. So we would prefer that investors put their allocation into an exchange-traded fund for their portfolio to balance out their portfolio, and we would avoid the gold miners altogether.
So let's talk about gold more precisely here. The metal is now trading at a 2-month low, but as you mentioned, you remain optimistic. So what forecast do you have for gold right now?
So our long-term forecast for gold is a return of 4 to 6% on an annual basis for the next 5 to 6 years. We also believe that you're going to start to see gold rally in the short run as volatility comes back into play going into the later half of this year. Our forecast on the short run for that is due in part because we think the Federal Reserve will start repositioning to more of a hawkish view. They'll raise interest rates roughly about twice in the next 18 months.
All right. So how do you suggest investors look at, getting exposed to gold right now? If the miners are out, do you like physical? Is it paper? How do you invest in gold?
So we invest in gold through the exchange-traded fund. To give you kind of a general understanding of why we do that, we want to have complete liquidity if we need to do that. We also invest in regular retail accounts, so we want to be able to break those trades up into individual accounts. But the critical component of this is that we wanted liquidity. We do believe gold will outpace the rate of inflation over the next 5 to 10 years, hence the reason why we're investing in GLD.
So is it really just, getting back to the miners, is it the volatility or the uncertainty behind them that prevents you from touching them?
So it's a combination of 3 things. One, it's balance sheet quality of the miners. They do have a lot of debt, many of them, as many of them don't. Also, you have to rely on the management of each one of these companies to understand if it's a quality management team, and then the reliability of the cash flow to meet the CapEx needs. That type of issue is why we would just prefer to invest in an exchange-traded fund and to be on the underline of gold. Because we do believe that gold will go higher and we're going to see higher highs over the next several years. We just don't want to go into any company-specific risk at this point in time.
So your current exposure to gold is about 5 to 7%, is that correct?
Yes, our exposure for a balanced or conservative investment account, and that takes into account the reality that they will have stocks and equities, domestic and foreign, as well as bonds, is roughly about 5 to 7%.
So if you're forecasting gold to go higher, would you change that allocation higher?
Yes, we would adjust it higher on pullbacks, but at this point in time, this is our recommended forecast. Our portfolio that we're managing is somewhat more tactical in nature, so we could increase that position over a period of time. Again, we believe volatility will come back into the marketplace for the general financial system. We're not doom and gloomers. We just believe that it's a great non-correlated asset to equities.
So what else are you liking right now besides gold?
Well, we would stay domestic with our exposure on the equity side as well as on the fixed income side. We believe, similar to our 5 to 6% total return, equities also have about a 4 to 5 to 6% total return over the next 5 to 10 years. So that's far off the historical mark there. We would also move up the quality spectrum when it comes to the fixed income markets. We want to be in the highest quality investment vehicles at this juncture. So we would be balanced in nature. So the balanced portfolio that we manage currently has around 45% in equity exposure, 7% in gold exposure, and the remainder, again, is in domestic high quality corporate bonds as well as individual government bonds.
All right, Chad, thanks so much for joining us today. It was nice chatting with you. And thank you for watching. We have more for you later in the day, so be sure to stay tuned.